Hi, I'm Scott Robinson, Director of the REIT Center at NYU Schack Institute of Real Estate. I am fortunate to be co-hosting our fall REIT Leadership Series with my friend and industry colleague, Robin Panofka. Robin co-chairs Wachtell Lipton's real estate and REIT M&A practice with Adam Emmerich, both of whom have long supported the Schack Institute, notably as conference co-chairs of our annual REIT Symposium held every spring in New York City. This REIT Leadership Series is designed to bring our students and numerous stakeholders into a direct conversation with some of the folks shaping our industry. Today's conversation with Sam Landy, President and CEO of UMH Properties. UMH Properties trades on the NYSE under the ticker UMH. The company owns and operates a portfolio of 132 manufactured home communities with approximately 25,000 home sites across 10 states. Sam is going to speak with us about numerous ways in which UMH addresses affordable housing, including recent efforts to bring a market-based approach to reducing the cost of home ownership in their markets. I also want to thank the many NYU Schack students who participated in this series, including today's co-host, Stephen Caffrey. I hope you find these conversations and the related research memos informative, and I look forward to exploring these topics further with all of you in the coming months.
So we are thrilled to have with us today Sam Landy. Sam is the President and CEO of UMH Properties, a public equity REIT listed on the New York Stock Exchange, which owns and operates a portfolio of over 130 manufactured home communities with approximately 25,000 developed home sites and significant land holdings for future expansion. We're also joined in the conference room by the UMH team, who we've invited to contradict Sam if they disagree with anything he says. So we'll see what happens. So Sam, really appreciate your doing this. I'd love to start with a discussion of your basic business model. And particularly, I found very interesting on your website, a quote you had, which said, manufactured home communities provide recession-resistant qualities, reliable income streams, and the potential for long-term value appreciation. Walk us through all of that, but particularly given the environment we're in, the recession part of it would be fascinating to hear about. Why are they recession-resistant?
So manufactured home communities have provided quality, affordable housing for decades, even before the 1960s, but 60s, 70s, 80s, 90s. And the primary model was a resident owned a manufactured home and rented a lot in a community. And so we're the community owner. We own the roads, water, sewer, clubhouse, swimming pool, those amenities, and people pay us rent for a lot. And that lot is generally a 50 by 100, 5,000 square foot lot. It could be 8 homes per acre. So these communities with that factory built house are incredibly affordable in comparison to conventional site built homes, not including the land. It costs 30 to 50% less to build the house in the factory. So there's been substantial demand for the product for decades, and there were only a couple times when demand shrunk, and those times were related to a lack of financing for the retail customer, and B, if there was a demographic shift caused by unemployment, which happened when factory jobs, steel, coal, tires, left the Pennsylvania, Ohio, Indiana area, and then people left, that type of recession, the industry felt. But generally, there's such a demand for quality, affordable housing that we continue on filling communities, collecting rent. Through COVID, we maintained 95% rental home occupancy and 98% rent collection because the quality of our product is so good and the affordability is so good that people paid the rent, found new jobs, did whatever they had to do to continue to pay us. So we're recession resistant in the sense that, you know, as a quality, affordable housing and all real estate's location, location, location. So if you're in a good location where nothing bad is happening to their local economy, then even through recessions, you may increase home sales, increase rental home occupancy, increase rents, increase profitability. And occasionally there can be a specific area that has enough of a local downturn such as when all the hotels closed in Monticello, or the loss of steel coal tire jobs in that Ohio, Pennsylvania area, where it could affect a community. But generally, we are recession resilient, and generally, Sam Zell pointed out that the resident-owned home in a community, when they've made an investment in their house and they pay lot rent, that's one of the most stable forms of income there is. And what was unknown, because UMH pioneered renting these houses out, was how stable that income stream would be for the rental home. Well, COVID proved that that rental income stream of the rented house was as stable as the resident-owned house because of the quality of the product and the affordability cap and people's willingness to make the payment and to find other jobs. They lost their jobs as waiters and waitresses. They found other jobs in warehouses, trucking, et cetera, so that they could make the rent payment and not lose those houses. So it has been a great industry, great business. And the demand and the need for affordable housing throughout the country is so great that our mission is to grow this, find more locations, and continue to provide more quality affordable housing through resident-owned and rental manufactured homes.
All makes good sense. I want to talk a little bit more about affordable housing later in the sale versus rent model. But before we do that, kind of big picture, inflation and rising interest rates are top of mind for a lot of CEOs. How do you think about that? Do your rents basically rise to match inflation, or are they fixed? How does that work?
So the rising interest rates and inflation, first of all, increase the affordability gap, right? So, $400,000 houses become more costly because the mortgage rates are higher. Inflation makes it cost more to build other forms of housing. So in the world of affordable housing, what we provide, we're providing housing for people so that 30% of their income should cover their housing costs. So these are generally, $40,000 a year household income, $60,000 a year household income. And as the prices of those other homes and apartments rises, those things become out of reach for them. And we're the only thing that's left. And in that regard, we could raise our rents more than 4%, but what we do is we try to limit our rent increase on the resident-owned homes to 4%, so that our residents who made a substantial investment in that house, now they may be buying that house for over $200,000. We want to preserve and increase the value of their home. We want them to have a great experience living in a UMH community. And so if we're able to reduce our expense ratio, even as costs are rising, so we can have an 8% increase in costs, only 4% rent increase. So by appearance, the expense ratio should be going up, but we have over 3,000 vacant lots to add rental homes. So if we can add 900 new homes to those vacant lots, we'll generate new revenue, so that that gap between the 4% rent increase and the 8% expense increase can be made up by new customers, 900 new rental homes a year at about $10,000 per year rent. And that will make up for it and actually reduce our expense ratio. So our residents are only on 1-year leases. So we do have the ability to raise the rents more if necessary. And we do raise the rents more when there's a vacancy. So when we have about a 30% turnover on those rental homes. So as they turn over, the rent goes to market to the next tenant. And the same with, if a resident-owned home is 40, 50 years old, becomes obsolete, we buy it, replace it with a new home, that rent can go to market. So we have room for rent increases. And an important point there, we also earn sales profits. So keeping these rents as reasonable as we can results in additional home sales, additional sales profits, additional financing, and additional finance profits. So we work very hard to manage our expenses, but still with inflation, they're up about 8%. But we believe that we can make up for that with increased occupancy and new rental homes.
Very interesting. You've used the term horizontal apartments, referring to your communities as horizontal apartments. How, explain that to us a little bit, but also how do you compare your business model to an apartment complex business model?
So exactly, the original model, which, many operators are still stuck in, is the resident owns the home and rents the lot. And that resident has to obtain financing to buy that house. And as the result of Dodd-Frank Truth in Lending, SAFE Act laws adopted in about 2009, it became much more difficult for people who need affordable housing to qualify to get that loan. We used to be able to use our own standards to finance home sales, but now you have to use government standards. And this dramatically reduced the number of homes sold. Industry shipments fell from about 300,000 units per year in the 1990s to a low of 40,000 in 2009, because the people who need the housing couldn't get the financing. So in 2011, UMH, after 3 bad years, realized the thing to do is just rent the houses. We can't sell the homes under these standards. People don't have the 10% down. They can't verify their income. Their debt to income ratio exceeds the government standard, but they have the income so that 30% of the income would cover renting these houses at a rate which began, we were grossing 20% of the cost of the house. So we'd buy the house for $40,000, put it on a vacant lot, and rent it for $700 a month, which is more than $8,000 per year. So that was extremely successful from 2011 to date. We've rented out approximately 9,000 homes. And in our sales first rentals, we rent about 8 homes for every 1 we sell. We have waiting lists for the rental homes today. We have minimal wait time between a resident vacating in a unit and the next resident, minimal costs to clean a unit from one resident to the other. If you think about the home rental REITs, they're buying many homes over many, many square miles. And so that's a very difficult management issue. We're taking 50 acres, and that 50 acres can have 300, 400 homes. And so we're managing the resident-owned home that they're renting the lot, and we're managing the rentals there, which is very easy to manage. So we had to explain to the lenders when we began this, lenders who lent on manufactured home communities did not allow more than 6% rental units in a community. And we had to convince them to make the loan on the community, even though we were adding rental homes. So we described what we were doing as horizontal apartment complexes. We were talking to Fannie Mae and Freddie Mac, the government sponsors entities. They make great loans on apartments, but they weren't lending on manufactured home communities with rental homes. And we spent considerable time speaking to them, meeting with them, attending, various government forums. And one of the things I learned, you keep repeating yourself, because even though people didn't hear us the first time, even though they didn't listen the first time, just keep saying the same thing. The manufactured home that costs 30 to 50% less than a site-built home is a better product for affordable housing than anything out there, and there's no reason not to rent them. Fannie Mae and Freddie Mac completely understand the apartment business, so we needed them to understand the rental home business in a community. And so when we began this mission, we had to obtain our funds originally by issuing 8.25% preferred. Then with a little bit of success, that became 8%, then 6 3/4, then 6 3/8. But we kept talking to the government-sponsored entities, and eventually they heard us, and we did a $100 million mortgage at 2.62% to redeem $100 million and 8% preferred. So you can imagine how profitable that was for the company. And from there, the program continued. So we're getting more GSE financings. They'll allow 60% rental homes in the communities, but they've also told us we're building Memphis Blues in Memphis that will be 100% rental home community. And as soon as we have adequate occupancy and revenue, they will do the whole mortgage on both the lot and the house. And so the first step was we had to get them to loan on the community, which they wouldn't in the beginning lend on the community, not even counting the house. Just in the last 6 months, they did a $25 million loan to us strictly on the home. And that's a major breakthrough that they're financing a home that is not permanently attached to the lot. A manufactured home is considered like an automobile, a boat, or trailer. It's a titled loan, it's a chattel loan. But really, when one person owns both, when a company like UMH owns the home and the lot, it becomes one dwelling unit. They can put one mortgage on the community and have a security agreement that says this includes the rental homes. And by convincing them of that fact, first they gave us the mortgage. Now they've directly lent on 1,100 rental homes, 25 million. We own over 8,000 rental homes, so there's plenty of room to increase it. But that's one of the biggest breakthroughs in UMH and the manufactured housing industry shipment, or industry's history. We already had a product that cost 30 to 50% less than any other product. But unfortunately, our loan costed 30 to 50% more. And UMH was able to convince the GSEs to reduce the cost of that loan, to provide more of that financing, to meet their mission statement, which is a duty to serve affordable housing. And we convinced them, and they agreed, that manufactured homes in land lease communities are a way to satisfy their duty to serve, and probably the best way to provide quality, affordable housing throughout the country.
So that sounds like with that breakthrough, the future of your business is in that direction. You're going to own the homes mostly. I heard the 60% requirement, but that sounds like it's coming down. So is that the future of the business, to move to kind of horizontal apartments as you've described it?
Yes, again, it's 8 to 9 to 1 rentals versus sales. And so what we're looking for, and what we've been acquiring, we've made substantial acquisitions over the past 10 years. We're looking for communities where the prior owner did not have the capital or the ability to switch from the resident-owned home model to the rental home model. And by buying that community from them, they have about 10 years deferred maintenance, because without adequate sales and move-ins, they couldn't make the capital improvements, and it resulted in deferred maintenance, lack of capital improvements, older obsolete homes. So we can acquire those properties, use our access to capital to improve the properties. We can buy old obsolete homes that are not energy efficient today, replace those with new homes, and rent these homes out, so that we can create a community that's a combination of resident owned and rental homes. And so we greatly increase the occupancy. We've taken communities from 40% occupancy to 90% occupancy. We greatly increase the occupancy, the revenue, the profitability, and the value, and we do it relatively quickly in 3 to 5 years.
So the cost of capital advantage you have will make you able to buy old style communities, convert them into horizontal apartments, for lack of a better term. Makes a lot of sense. But why can't an existing mobile home unit go, now that you've opened this the Fannie Mae option, why can't they just go borrow from Fannie Mae as well and buy some homes? And
we've made it easier for them, and at the same time, we've generated a ton of competition. People have seen our success, and many people seek to buy the very communities we previously were one of the only bidders on. So we've generated a lot of competition, and we've created for many mom and pop community owners the ability to turn to that model. But sometimes they don't do it anyhow. We had one particular community where the family had built a beautiful 400 space community. They built it in the 1970s, and they were actually emotionally attached to the houses that they had sold that were there, even though they were obsolete. And they didn't want to remove them and replace them with new rental homes. So we were able to make that acquisition. So there's still going to be acquisitions open to us. But as a result of the competition we've generated through our success, we've now shifted gears again to the model of working with developers to build us communities where we can use our model of homes for sale or rent, use some of the sales profits to reduce the construction costs. So if it costs $100,000 to build a lot and we can earn a $30,000 or more sales profit on that lot, it reduces the cost of the lot. So a newly built community becomes more profitable and more attractive than even the turnaround communities we did in the past. And our first major hurdle there were almost no developers in the country trying to build manufactured home communities. Some people like us who owned communities might have sought to expand their communities, but almost nobody was trying to build new communities. And we went out and we got the message out that developers, your standard developer who normally builds a subdivision, condos, or apartments, that if they could go out and find land and get the zoning approvals, we would pay them a $10,000 per lot profit. So we could all look at, 50 acres, what would that be worth in that area? You might say 20,000 an acre. What would the engineering cost? And you could figure that out. And then on top of that, we'd give the person a $10,000 per lot profit. So if they could get 200 lots approved, they could make $2 million selling it to us. And we got that message out, and many people are out now trying to get approvals of land to build manufactured home communities, which will benefit the entire industry. And that, in fact, is what resulted in our joint venture with Nuveen, so that we were able to do Sebring, and we'll do other deals in the future.
So how big a constraint is zoning? You read in the paper that a lot of communities don't want manufactured housing for whatever reason. Is that resistance dissipating, or is it a serious problem?
So in your high population areas, California, New Jersey, Eastern Pennsylvania, Eastern New York, the not in my backyard mentality is so strong that we reach the conclusion that zoning and getting approvals and rezoning land is virtually an impossibility. Even on expansions, it can take us 15 years to get approvals if we get them. But then when you leave these markets and you go to Tennessee, Western Ohio, parts of Indiana, Western and Central Pennsylvania, and we've acquired communities that needed to be turned around, that the prior owner was not maintaining them in a good enough manner to, the mayor, the police department, other people would be angry at the community owner, and we'd come in and make improvements so that we became friendly with the mayor, council, building department, police. And so when we asked to expand those communities, our approvals were generally granted in a relatively short period of time. So we have Duck River, which is approximately a 300 space. It's really a brand new community. It's adjoining Countryside, so sometimes we call it an expansion. But because we turned around Countryside, which was a 360 space community, when we asked for approvals to build Duck River, we received them. And that's happened at a number of locations where, the municipality saw us take an eyesore and make it a really pleasant, nice part of their community. And many times the people who work in town hall wind up living in our community because it's such a great, affordable place to live. And so when we create that atmosphere and we ask for our approvals, we generally get them. And so our only exceptions are Eastern Pennsylvania near Allentown, Vineland, New Jersey, and we won a federal lawsuit in Coxsackie, New York. So hopefully we're going to get those 360 lots approved. So we're well aware zoning is a major issue. We try to tell anybody who's listening, it's really not fair that a local municipality has all of the say in who gets to move into their community. All municipalities get money from the state, county, and federal government. So how can it be just the people in charge of that town can say, we want to be the last person who ever moves into this town, and we're not going to allow any more housing? It's a terrible situation, but we don't know of any solution. But as we get away from these high population areas, it becomes easier and easier to get the approvals.
Yeah, no, I think generally for affordable housing, people are looking to the state to override the municipalities because of the NIMBY concern you're describing. but obviously a politically charged situation. So you mentioned the Nuveen joint venture. You've also got an opportunity fund, opportunity zone fund. How does that work? And how does that interface with the REIT?
So both the Nuveen joint venture and the Opportunity Zone Fund are for the idea that when you go to build a new manufactured home community, it's going to be extremely difficult for it to be profitable within 3 or 5 years. Yet UMH has recognized how substantial the demand for quality, affordable housing is and how well we can fill that demand. So we want to go out and we want to build all the communities we can. But if we did that as UMH, that those losses in the first 3 years, you'd have a manager, you'd have marketing, you'd have maintenance staff, you'd be cutting the grass on vacant lots, and you'd have minimal revenue because you're only filling a certain number of lots per year. So that would negatively impact our FFO, which would negatively impact our stock price, which all becomes a bad situation. But our objective is a good objective in terms of long-term if you build communities that will add to the profitability and value of UMH. So the solution is the Nuveen joint venture, which they're a 60% partner and we're a 40% partner, and they immediately pay us asset under management fees and management fees. So we immediately earn income even while the property is losing money, which stops that drag on FFO as we get these properties up and running. And so we did the same thing with the Opportunity Zone Fund that will get asset under management fees and management fees. The Opportunity Zone Fund idea is extremely exciting as is, because many people have capital gains. And if they put their capital gains in our Opportunity Zone Fund, and we invest that money in opportunity zones, which are by definition underinvested in areas of a state, town, county, where the governing body has recognized they need to do something to improve the housing and employment in this area. So we can invest in those areas, which by their nature are going to take a longer term to turn around because the demographics at the moment are not there. But UMH has already had success. We've done 7 properties that were in opportunity zones without taking advantage of the law. And we had substantial success upgrading and turning around those properties. And when we invested in the properties, the neighboring property owners invested in their properties, which completely upgraded the area and fulfilled the mission in terms of there was better quality, affordable housing. Employers want to locate near our housing because they need workers. And if the workers have a place to live, that's a good place to create your business. So we know the opportunity zone ideal will work. And we went out and we looked for communities to build or rehabilitate in opportunity zones. And we actually found there's more of them in opportunity zones that are available that make sense than anywhere else. Because again, by their nature, a lot of people, just turn down those areas because it's more of a long-term investment. Right. But then when we went to raise the money for our Opportunity Zone Fund, we found out it's more difficult than anything we ever did before. Usually, I enjoy the fact that sitting in this office without leaving this chair, I can raise $100 million just getting on the phone and calling the investment banks and say, hey, we got some communities we want to buy. We need to raise $100 million. And in a week, we have the $100 million without me ever leaving. But when we went to do that with the Opportunity Zone Fund, it couldn't be done. And when we said, why can't you do it? They said that 180-day provision that people have to invest a capital gain realized in the last 180 days. And there's only a limited number of people who have realized a capital gain in the last 180 days and want to make an investment that's going to be a 10-year investment, because by holding the investment 10 years, they get the stepped up basis and pay no capital gains tax when we sell the property to UMH in 10 years. So it's very beneficial for the investor, but there's a limited number of people who can make that investment today. So because we're in New Jersey and know Senator Menendez and Senator Booker, we are working very hard to change that law at this moment so that any investment doesn't have to be a capital gain, any investment, so that any 401k, retirement plan, pension plan, anyone can invest in affordable housing in an opportunity zone, hold it 10 years and get the stepped up basis. And if we succeed at that, we believe we're going to have a substantial amount of money to build and renovate manufactured home communities in opportunity zones, improving housing for people who need it, and creating a workforce in those areas which will attract employers. So it's a very exciting concept. We're working on it right now, and hopefully we'll get that done.
So given the constraints on raising capital, has the Opportunity Zone Fund really kicked off and made investments, or you're waiting to raise that capital?
Well, fortunately, we were able to kick it off. That has about 11 million in capital, and it's open until December 31st to continue to raise capital. And I believe they've already closed 2 deals.
Closed one in Orangeburg, South Carolina.
So we've closed 1 deal to date, but we have other deals pending, and we're very excited about the pending properties and the existing deals. And we're sure that, you know, from UMH's history, renovating, turning around properties, we're going to turn these areas around, and the investor is going to pay no capital gain in 10 years. So it's a very exciting concept.
Yeah, no, it makes a lot of sense. So let me ask you one more question, then I'm going to turn it back to Scott and Stephen. Stephen, we're going to ask you to report on all of these figures. This has been kind of a head-spinning amount of information. So
sounds good. I'm going to jot down all the mental notes.
This is fascinating. But before we get to that, let me ask you kind of a big picture question, Sam, about affordable housing. You've got a unique vantage point into this problem this country has, where we clearly are short of affordable housing. I'm sure manufactured homes is part of the solution, but if you were czar of affordable housing in America, what would you do right now to deal with the incredible shortage we have?
Well, it's correct that zoning is the #1 issue and financing is the #2 issue. Just saw an article today about, you know, accessory dwelling units in California, that you could take a manufactured home and, you know, if you had, say, a 1/4 acre or half-acre lot, put the manufactured home right behind your house to rent it or for a family member. And, you know, that's a major solution to the shortage of affordable housing. Zoning, you know, is the major issue, you know, speed up that process. You know, I can get a little extreme in my desire to create affordable housing. Take wetlands laws. Wetlands laws are designed to protect wetlands. A wetland should be something that's wet. The original federal wetlands manual said you were wet 2/3 of the growing season. But wetlands today means you have a, you know, completely dry site that has wetlands plants on it and is deemed a wetland. So, you know, people have to prioritize, do we want quality affordable housing, or do we want to protect land that's not wet? We need more financing, we need more zoning, we need to get regulation that stops the creation of affordable housing out of the way, because it's incredibly unfair to a substantial number of people who can't mobilize. They're stuck where they live, and where they live might be a really bad place. And there's no way out of there because suburban America will not allow someone like UMH to build a 300 space community in their town. So it's a major problem. And then financing, the lower we can keep people's costs to finance, if they're buying a manufactured home or if we're renting the home, the lower we can keep those costs, the more affordable our product is to a greater number of people.
Let me ask you a crazy idea, and then I'm going to turn it over to Scott and Stephen. What about going vertical with manufactured housing?
Well, we are highly interested in that, and you know, we've
It's not crazy.
No. Actually, there's a manufactured Hall of Fame in Elkhart, Indiana, and they have pictures, and a person's actually physically done it, where they made a steel frame and used a crane and placed the manufactured homes into that frame. At the time, they used stairs, and elevators probably a better way to do it. Ratner did it outside of the city. Factory built the homes and lifted them up with a crane. We consider in our communities to be higher density in terms of larger families living on the same acreage. You could take a 1-story manufactured home, make it 2-story. You could do that in a number of ways with steel columns, placing the second home on it, or with superior wall concrete systems. So we very much believe in going up with manufactured housing.
I thought I invented the idea, but there you go. You double your capacity immediately.
My father says the test of a good idea is somebody else also has it. So it's a good idea, yes.
That's a good line. That's a good line. Scott, let me hand it over to you.
Yeah, thank you. Look, Sam, I think you hit on this a lot. Affordable housing has been an issue, increasingly since the pandemic. But there aren't too many REITs, or at least I should say there aren't too many affordable housing groups that are using the REIT structure. Your business is obviously a little bit complex if you don't think about it too much. You've got the sales aspect, rental aspect, land lease versus structure. Does the REIT structure work for you? And if so, how? And do you see more affordable housing groups using the REIT structure?
Well, the REIT structure works incredibly well because it's our access to capital. And it's the access to capital that lets you grow and create this affordable housing. Being a publicly held REIT, we could raise money in the equity markets, preferred stock, debt. Those are incredible advantages that other people don't have that allow us to continue to grow. The REIT model gives the investor their dividend plus liquidity. The Opportunity Zone Fund, the biggest negative to that at the moment is it's not liquid, but there's no reason when we grow it that it can't be a publicly held Opportunity Zone REIT. And the benefit, that 10-year tax benefit, so in year 1, it's only worth one thing, and in year 9, it's worth another because you're closer to the realization of the gain that won't be taxed. But that would flow with the security. So the REIT security, the REIT structure is, look at all the forms of real estate it's been great to, but it's also great for affordable housing. We've used it and we'll continue to use it.
Well, you also have OP units, right? You could do a 721 exchange to acquire assets, and there's a tax benefit in doing that as well.
Right, and we have not gone that route, but we know it's out there.
Got it. You mentioned access to capital. I know earlier this year you listed on the Tel Aviv exchange on TASE, and you did an Israeli bond offering over there. Do you see more U.S. REITs and hopefully affordable housing access global capital?
We think so. My father recognized that interest rates outside of the country at that time were lower than inside the country. We could raise capital outside the country at a better cost. Leader Financial, Michelle Naveau, we did the $100 million unsecured debt issue. It was extremely successful. Plus, we met, Israel's a small country, and there we were dealing with $100 billion insurance companies that want to invest both equity and debt in UMH. So it was extremely beneficial, met great people, and we think it will continue to support our growth.
I've got one more question, kind of has to do with how long, people like us have been around the block, and then I can hand it over to Stephen. But there's been a lot of hoopla over build to rent, single family rentals. In a way, it just kind of seems like what you've been doing, but with a different label around it. Do you see much difference? And maybe do you see density changing in the MH space?
Well, our benefit compared to theirs is the cost of maintaining and managing the units. Again, it's many homes on a small piece of land, so it's very easy for us to manage, where theirs is much more difficult to manage. When conventional homes are appreciating substantially in value, they have the advantage of, they own the land, they can sell the homes and make a profit for their investors that way. We keep the community, and rent out the house. So the rents go up every year. So that will be we've figured out that renting a home versus selling it is more profitable over the long run than selling the house. But if you're looking for short-term profits, selling that house creates nice short-term profits. So the rental home REITs have that advantage that when houses are appreciating, they could generate some extra profits selling homes. We won't, predominantly, we don't sell the home. We keep it as a rental home, but long term, because these homes are going to last as long as any other home, we'll collect rent for 50 plus years with that rent going up 4% or more per year. So long term, the rental model's even more profitable than renting homes and selling the homes.